We have again Mike Zuzolo on Connected Farmer, and he's going to speak about the rising demand for U.S. grain in the second half of the year, the possible improvements for the U.S. economy and its effects on U.S. grain, and also the impact on the weakening dollar for the U.S. farmer, right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Mike, um, I'm going to do a question more on the longer term, but I would like to know from you if soybeans can get close to $10 a bushel in the next 6 months. How are you today?
I'm doing well, thank you, Louise. I think that's a good place to start because I think since the last time we spoke, we talked a lot about the Brazilian price at Paranagua and the idea that the soybeans in Brazil and Argentina and corn, maize could also be leaders out of South America as far as the cash prices. And they're really ultimately, other than the U.S. election, I think they are ultimately going to dictate how high our bean prices can get. I know a lot of analysts would say that, well, if we have a continued dry weather event here in the United States, we're going to keep taking yield off the soybeans. But I think that your question at $10 November soybeans would suggest to me that the market is already pricing in some pretty hefty yield losses here in the United States crop. And so it really goes back to Brazil's price, and then that translates back into how much China continues to buy from us and whether we have any worries or fears of cancellations in soybeans by China in case tensions do get worse, as we've talked a lot about. And so as we go on the air here this week, we're dealing with the Brazilian Paranagua price just around $420 a ton. The Argentine price is right around 375 plus or minus, and we're all the way down still at about $370 a ton. So compared to Brazil, we are still $50 a ton cheaper, and that gap has gotten wider, Luis. So I don't see that changing too much. In fact, I think most of the downside potential in the soybeans is probably going to be delegated to the USDA crop report. If there's any kind of bearish shock or something like that, that would probably open the downside up. But if the Brazilian prices remain this strong, I suspect the trade will buy into any kind of price break at this stage, especially with harvest not starting yet.
One of the reasons I asked this question is because the Brazilian 2021 crop is getting about 60% sold on forward sales. I think there will be nobody else, no other place to go, considering that there is still 4 months for the year to end.
And this goes back to our talk last week about whether China needs all of these beans, because they clearly are buying the vast majority of both U.S. beans and Brazilian beans at this point. Meanwhile, as we talked about last week, they're signing a longer-term agreement with Russia to produce soybeans in Russia for China and for China's consumption. And so I think longer term, and I think this past week we have gotten more news out of the market and out of Asia that China could have a significant shortfall in corn and wheat and other feed grains as opposed to soy. And so this goes along with what we've talked about, and I hate to repeat myself, but I think it's good analysis, and I think it's bearing itself out that we're starting to see a scenario develop where the soybeans are putting a premium back into their market, taking bullish news, pricing it in, whereas the corn is very slow to do that and has been very slow to do that up until about 3 weeks ago. But if I were more concerned about cancellations from China, the one I'd be least concerned with would be pork. The second least would be corn, and the most concern I would have about cancellations by them would be the soybeans, and then followed that by wheat. So that's kind of how I'm looking at it from a standpoint of how do I make my bins pay for my clients? What kind of crop do I store? I think it's by far the smartest thing to store right now is the corn for a variety of reasons.
I want to have your first further analysis on corn. Yesterday I talked with one person from the U.S. Grains Council, and he was pretty optimistic about the Chinese purchase is in the second half of the year, not only for the coarse grain, but for DDGs and ethanol.
That's correct. I think you're going to be looking at anything that you can substitute feed grains in and out of because of the price. Whatever's cheapest, whether it's DDGs or sorghum or corn or feed wheat, I think the Chinese will be very active buyers. The thing that we've picked up over the last week or so, and this comes straight out of Asia, is that the Ministry of Agriculture is challenging the numbers domestically. They are going in and having audits in certain provinces of China to find out whether the stocks that these provincial leaders have put down on the piece of paper are actually there or not. And so they are auditing themselves. And we have heard a lot of chatter and rhetoric from President Xi about food security, about consuming less food, about trying to not waste food. All indications that I see right now are that the Chinese demand base for feed grains is growing in terms of imports. Some people are kicking around in the industry that the Chinese are about 50 million tons short in their needs for corn over the next marketing year, and that 10 million of those tons could come from the U.S. in terms of increased imports. So instead of importing 7 million tons of corn from the U.S., which the USDA is suggesting right now, that could be 17 million tons for the marketing year if these anecdotal pieces of information add up to be the case.
Well, then taking a look over a longer term, what about if in the next year the African swine fever issue gets resolved? Are we seeing a risk of market crash here?
You know, this is going to be tough because we have to balance the tighter supplies with the future demand. And what I mean by that is that most of what we've encountered, Luis, has been tightening supplies, has been due to weather, or for instance, Brazil running out because they oversold their bushels. They are tighter in supplies, and China had to come to us, or the phase one trade agreement, the Chinese trying to make good on that. Is it true? Is it real demand? And is that demand sustainable because of the potential, I think, that's growing that we go into another recession in 2021? And I guess ultimately for me, before I can answer that question for you or for my clients and subscribers, I really need to know who's going to win the U.S. presidential election, because trade policy, foreign policy, domestic policy, and Federal Reserve policy are really, all four of those are on the line on November 3 when we go to the polls. And I think that's where we are going to see, I think, and I think we may be seeing it already in the equities markets and the stocks here in the United States late this week. We're seeing a significant pullback. And I will bet at this stage that that's probably because the polls are showing Vice President Biden gaining, not just nationally, but in some of the battleground states. If you look at some of the big polling places, I personally like using Real Clear Politics, the website, because they do an overall poll of all the big pollsters. So they really they cover both the liberal and the conservative, and they kind of blend that together and average it out, so to speak. And I like that. But I think as we get closer to the election, you're going to see grain volatility, currency volatility, equity volatility all get sharply higher in this next 60 days, because we are exactly 60 days away from it as you and I talk today.
Well, and about the domestic demand, how are you seeing the evolution of ethanol demand and other energy prices? We are seeing the news of potentially a vaccine being distributed by November, so that is going to affect the economic recovery there.
It is, and I think that's a really good point to bring up. One of the things that I think that's happened this week that's kind of surprised me has been the fact that the ethanol margins are starting to really climb nicely. The mercantile exchange ethanol margin right now is almost 20 cents a gallon positive. It's been a while since we've seen something like that. So the weekly energy data from the Department of Energy was very skewed this past week because of the hurricane that came through the Gulf of Mexico. But the market probably took that data as neutral or somewhat negative when it came to ethanol. However, the forward-looking data with these margins improving would suggest that if that vaccine comes in December, like the president's talking about now, and the CDC is even talking about it in a letter to governors, if that happens, then we may be able to salvage quite a bit of our late 2020 and early 2021 demand. So if you add that together with the livestock feed, and especially the fact that we have put a lot more cattle, feeder cattle calves, into the feed lots because there's a terrible pasture issue that you and I have talked about that's only gotten worse since we last spoke. You're not going to have a backing off of livestock feed. Poultry production is still ramping up, and hog production is still not peaked at this point. So domestically, that seems to be the brightest spot for the corn and bean trade. And it's interesting you bring this up, Luis, because I contrast that with some really bad cash basis levels around the country for corn and beans right now. And I can't explain that to clients and subscribers why that would be, except the trade is just outright nervous of taking on too many bushels before the election and before they know the final yield here in the United States. So that is a real focal point for me the next 60 to 90 days, is to see if we can't take, say, a negative 45 basis for fall beans to deliver into an elevator and see that climb to maybe negative 20 and improve our selling price by 20 cents just by a basis improvement.
And you've been talking about good hedges for wheat recently. How those farmers that did those hedges that you recommended, are they well financially right now? Are they better?
Well, I can't say too much from a compliance standpoint, but I will say that because there's just as much risk of profit as there is loss, or loss as there is profit. And so, but what I can say is I am pleased that we held back on the last of our 2019 hedges for wheat until this past week, because it was a multi-month high that we sold the rest on. I think the clients have been very pleased that we've been able to sell above 940 November beans for a large chunk of our cash bushels. I had put some puts in place, some floor prices in place at the Mercantile Exchange, and had spent quite a bit of money doing that because I'd done it 2 or 3 times, and each one of those cost roughly 15 or 20 cents. And so it would take a lot for us to offset in risk reward for those prices to get up to levels to offset those. Well, we're doing that now. And I think they're very relieved because they are worried about their yields. And so they haven't oversold their cash bushels at $9 November futures and wondering, what am I going to do if I don't have 50 bushels to the acre now? And so I feel real good about where we're at. I feel like we have some control over the markets again, and we have a chance for profitability. These last puts I put in place, I recommended the clients a couple months ago to put these puts in place. We were right on the cusp of breaking through 840. The puts only cost about 12 or 15 cents. And look at where we're at now. We're, over $1 higher at this point. And so that my goal has always been, whatever I risk on paper in soybeans, I'd like to get a 3 times better price. So have a 3-to-1 risk reward in soybeans and a 2-to-1 risk reward in corn and wheat. That's my goal every time, or almost every time I put a recommendation out. So this time around, we've been able to accomplish that really nicely.
How are you seeing the overall farmer profitability in these times? Because the U.S. government is cutting the cash help for some farmers. So how would they prepare in these tough times?
Whether it's right or wrong, we in the agriculture industry, and I can tell you the people in the energy industry that I know, are very nervous about a Vice President Biden win because the green energy mindset and policies that he may enact could be negative, the traditional commodities, and therefore the subsidies and support that we have gotten traditionally when low prices have come around, those may be cut or trimmed or cut drastically even. We just don't know. And so I think we're very nervous about the prospects of a higher dollar if Vice President Biden wins, which I think is likely. And we're much more worried about the farm policy and the clean energy mindset that Vice President Biden may bring to the table when we feel like that the biofuels, both biodiesel and ethanol, are very good clean energy vehicles to help lower our green gas emissions. We could do better. We could always improve, but I think the seed companies and the technology have been on that for the last several years, where we're getting better at needing less nitrogen for our corn because we're putting that into the seed DNA and putting that into the genetics. And so I think clean energy still rooted in corn and beans if the technology can continue to improve as opposed to putting out out of work a whole group of people that are the backbone of our country.
How are you seeing the margins for the livestock producers?
They're mixed. We are getting back up above $60 in February hog futures, and I've been putting that out to my clients that we're on kind of a red alert. If we could get to $65 in February futures, that would be a good hedge for me and get them back to profitability. Especially with Chinese buying and that market price getting factored in, that factor getting factored into prices. Cattle, we're right on the edge of being able to make money again. I think we probably need about a $10 rally in fat cattle, given the prices that some of the feeder cattle traders that I work with priced in earlier this year. So we need a bigger rally in the fat cattle because the cash feeder prices were a little bit higher than what the board price was when guys were buying calves.
Something else to add, Mike?
I think the only thing I would add at this point, Luis, is the idea that as soon as those South American prices start to top out, what the market's trying to do right now is go up and find where the demand walks away from the table and where the demand stops. And so we go up in terms of trying to find out how much the demand side can take. If we continue to see China buy as prices go higher, I think it takes it makes the USDA report maybe less important or less market worthy to trade. But like every USDA report, I'll breathe a sigh of relief once it's over. So that this next week is really critical to keep the Chinese buying on these higher prices and not get any kind of negative news or fundamental news from USDA that would kind of cut short this rally, because we're right around the cusp of getting harvest started here in the United States. And so that's kind of the factor that I'm watching here is if USDA puts out negative numbers and then we go right into harvest, does that give the funds the ability to go ahead and sell a lot of what they just bought?
Hey, how is the weather in Kansas right now?
It's still too hot. We got a little bit of rain where we're at, but there are a lot of cornfields that look like it's mid-October. They are totally brown. And I've heard that all the way across to western Illinois at this point, where there are fields that are dying prematurely. One of my clients in Nebraska actually went up into a plain yesterday with his dad and surveyed irrigated fields in Nebraska, and even those fields had spots where the corn was completely burned up and brown at this stage. So yields are not going up, in my opinion. They're going down, even on the corn.
Mike, thank you.
Thanks, Luis.